Hi everyone, I'm Aura Ogorian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go beyond the blog and answer some of your most important questions. Today, we're going to talk about the new rule related to inherited IRAs. And I say new rule because it went into effect after December 2019, and it affects inherited IRAs, and there's a 10-year rule. So stay tuned and we'll dive right into it. But before we begin, remember to subscribe, like, and share our channel. And if there's a topic that you want us to cover, be sure to include it in the comments section below or send us a message, and we'll be sure to include it in a future episode. Let's first define what is an inherited IRA. An inherited IRA is when someone, a beneficiary, inherits the IRA of someone who's passed away. So for example, if a father passes away and has an IRA, and then the beneficiary of that IRA is their child or their nephew or their niece, that child, the nephew or the niece would then be the owner of that inherited IRA. Now, why is an inherited IRA important is because the inherited IRA now is subject to what's called required minimum distributions. Whoever inherits that IRA has to start taking money out of that IRA. And prior to 2019, the rules were very different on how that money was taken out versus after 2019 when those rules were taken out. Why is the distribution on an inherited IRA so important? It's because the amount of income the person has to report that has an inherited IRA. Prior to 2019, the beneficiary of an IRA could stretch the distributions over their lifetime, meaning if they took the distributions over their lifetime, every year they'd have to take a very small amount over their lifespan and then report that as income and pay tax on it. But after 2019, because of the Secure Act, now anyone who inherits an IRA, well, not anyone, because we're going to go through some of the exceptions, but for most people who inherit an IRA, they have to distribute that money over a 10-year period. And that's significant because now they have to report all that income in a 10-year period and pay tax on it, which is significantly different than before, where people were able to stretch it out over their lifetime. So what are some of the exceptions to the new inherited IRA rule? Well, first off, it only applies to people who passed after December 31st, 2019. So if a person inherited an IRA before that, they are still subject to the old rules, meaning they can spread it out over their lifetime. But if someone inherits an IRA January 1st, 2020, they're going to be subject to the new rules, which is the new 10-year distribution rule. Another exception is someone who's a spouse of the deceased. So if a husband passes and leaves the IRA to the wife, or the wife passes, leaves it to the husband, then it's not subject to that new 10-year rule. Another exception is someone who inherits an IRA who is chronically ill or disabled. The exception would apply to them as well. Also, it applies to someone who the beneficiary is no less than 10 years younger than the owner. So as you can see, there are some exceptions to the new 10-year IRA rule, but for the most part, people who inherit an IRA, a non-spouse beneficiary, they are going to be subject to the new 10-year distribution rule, which means that they have to liquidate that account within 10 years and pay tax on that money. One common question that we get often is about the 10-year rule itself. Does the money have to be spread over 10 years? Can they take it all at once, or can they wait till the 10th year? And the rule is that it just has to be liquidated over that 10-year period. So if you inherit an IRA and it's after January 1st, 2020, you can either take all the money out all at once, you can spread it out over a 10-year period, or you can just let it continue to grow and then take it out on that 10th year. Now, keep in mind, if it's a sizable IRA that you've inherited, you're going to report a lot of money on that year that you decide to take that distribution. And if you're very careful with your tax planning, if you know that you're going to have one particular year where your income is going to be very low, you may want to take out a larger portion or the most of that IRA in that one particular year.